Imagine you worked your whole life, raised a family, and finally hit your 60s and think you've done everything right. Bought rental properties, paid down debt, planned to retire mortgage-free, but then the market turns and your forever home drops in value by $500,000. And on top of that, you've just locked in your mortgage at a really high interest rate for the next 5 years. That plan you spent decades building, it starts to crumble. And that is exactly what happened to this Wellington couple. So in this episode of the Property Academy podcast, you're going to learn if property investing still works, what happened to this couple, and what they could do to fix it. Let's dive in.
Now, it's pretty scary, Andrew, to see a headline like this and stuff. They own 3 houses, they're approaching retirement, and they're terrified of losing everything. So who is this couple and what's their situation?
So I actually got sent this article by maybe 10 investors that I work with. And so I said, we have to do a podcast on this because the headline was pretty scary. Like reading that, I was like, these guys, poor, they're obviously in a really bad situation. So they're older people, they're a few years out from retirement, they've got their own home and 2 rental properties, and they're really worried about losing everything now because, 2.5 years from retirement, they haven't just had the value of their house drop, but they've had the value of both their rentals that were going to sell drop. They've lost on paper $500,000. They're not out of pocket $500,000 until they sell that property, but they're absolutely down on paper $500,000 at the moment.
But what's really interesting is as you read this, on paper, these guys are loaded. Now, we don't have their exact numbers, but we can tease some of them out from the article. So we know that they had their original home and it doesn't have a mortgage on it. We also know they've got an investment property that also doesn't have a mortgage. And we know that they were going to move from their original home into a new property that they've purchased, which was going to be their forever home. And we do know that that had a lot of debt on it, and that this is the property that's dropped in value by about $500,000. Now, I happen to know that they are in Wellington and that the Wellington market has approximately dropped by 33% at its worst. So I'm going to assume that maybe the value of their kind of forever home has dropped from maybe $1.5 million to $1 million. And I also know that their original plan was to sell their original home, their first home, and completely pay off the mortgage on their new home, which meant that they could just live off the rental income of their investment property. Now, I don't have all of their numbers, but I would assume that, this is basically the case, that maybe their original home is worth, let's call it $1 million, which has probably gone down in value. They've got an investment property. We could assume it's maybe around $800,000. And then they've got their new home, which after falling in value might be worth something like $1 million with probably quite a large mortgage. Whether it's $1 million mortgage or a $900,000 mortgage, it would certainly be a big one. But this is kind of their situation. But one of the things that I was thinking about is these guys have got a lot of cash. They've got a lot of money within these properties. Why are they feeling so terrible about their situation that they're writing into a national newspaper?
Now, it's not clear in the article that all of the properties are in Wellington, but just knowing DIY investors, and I think these guys are DIY investors because there's a lot of things here that make me think these guys haven't had a lot of financial advice. It's just my guess, and as such, they've probably got 3 properties that have been hit hard by the drop because Wellington's had it the worst, right? So their own home, their dream home, has now dropped in value, and they've got a mortgage that they were hoping to pay off with that other home, the original own home. Well, if they sell that, they're not going to have enough to pay it off. Now they're going to go into their retirement, which is looming, with a mortgage still on their property. And so they've kind of had it from all angles. And so in their mind, they're now panicked, okay, well, we're still going to have a mortgage and we're not going to be working. And we're hoping to keep that investment property for a bit longer and live on the rental income. Things are going to have to change. So now they're disappointed with the fact that, well, my value's gone down in my original home. My value's gone down in my dream home, and I'm a bit disappointed because I could have bought it at a cheaper rate. I've got this big mortgage on it, and I'm not going to be able to clear that with just selling the old property, having this kind of bridge loan that I was expecting to be able to pay off when I sell my original property.
Now, there's a couple of things, though, that are a bit of comfort. And one of the things you sometimes see when couples are thinking about their own financial situation is they are so close to it It's really hard to step back and give yourself impartial advice about what you should do next. It's a bit like, if I go to the gym and I'm trying to do some workouts and I'm struggling with a squat or a deadlift, it's quite hard to correct yourself. And sometimes you need somebody else looking at you and saying, this is what you should be doing differently. Now, again, we don't have all of the details, but there are a couple of things that they seem worried about, but they almost ought not to be worried about it.
Well, I think one of the big ones is that their own home dropping in value. And yes, they could have bought it cheaper if they'd known the market was going to change, but they didn't. And it doesn't matter. Like if it'd gone up, they're not selling it now either. So what's the difference? If it goes up or down, it really doesn't change the things. You've got a mortgage on that property. You did your numbers based on that mortgage amount. Yes, you might not be able to pay that off in full by selling your original property today, but you did take on that mortgage knowing you could afford that mortgage and you're happy with that. So it kind of doesn't matter that it's dropped. The value of your owner-occupied property has dropped because if it had gone up, you weren't going to get the gains, nor are you going to take the losses. You're not selling it.
Yeah, this is a big point because they seem really worried about the fact that the new home has dropped in value, but that doesn't matter until you eventually sell it, but they weren't planning on selling it. What does matter is that property number one's value has dropped. Now, we don't know by how much, but this is about saying we've got to worry about the right things first. And the fact that the original home has dropped in value, that would be a concern because you were planning to sell that, pull the equity out, and then pay the debt off the new home. The other thing that's making me think that, these guys have DIY'd this, they haven't talked to a lot of people, is the other thing in the article that they talked about is they are really worried about, they said there is a heavy burden. They fixed one of their mortgages for 5 years. So they fixed it for 5 years when interest rates are higher, and now the interest rates have gone down.
Interesting that they, firstly, fixing for 5 years is something that you do if you need absolute certainty around repayments. But it was pretty clear that interest rates were going to head down. Like that was there wasn't probably any of the banks, and the Reserve Bank made it quite clear that interest rates, when inflation was under control, they were going to come down. So I find it a bit unusual if you were to get advice and then fix your entire loan for 5 years. That seems a bit odd, particularly because you are planning on paying off that mortgage at some stage in the near future as well.
That's the real thing. If you were planning on paying off that mortgage in, say, a year or two, and you've fixed it for 5 years, you might potentially have to pay a break fee if you're paying it off early. So that's something that kind of wouldn't be the usual steps you'd taken. Now, the reason they might have done that is if the 5-year rate was the lowest rate available to them at the time, they might have said, well, we just want the lowest repayment today, even though a couple of years later, they're now saying this is really difficult.
But then if that's the case, you've done your budget on that rate. Like if you've locked in for certainty, you can't complain about that certainty later.
Well, we're obviously not berating these people because they're obviously feeling like in a really rough situation. But I think it's important to go through and say, okay, there are a couple of decisions here that wouldn't be the usual thing you'd do in this situation. But what I would say, the real issue that they've got is that property number one has fallen in value. The fact that property two may have fallen in value actually, again, is neither here nor there. That doesn't really matter because you weren't going to sell that anyway. Their plan is to keep that for rental income. The fact that property three has fallen in value, that's neither here nor there either because, again, they weren't going to sell that. All that matters is what is happening with property number one, and is there enough equity in there to sell that and clear the mortgage as they were thinking. And the real issue is that because they are 60, 62, 63, they're not that far away from retirement. They don't necessarily have the time now to ride out the cycles, right? Property values, especially in Wellington, have fallen quite substantially at their worst in some parts of the city, 33%. Others have fallen by about 25%. If you are 10, 15 years away from retirement, again, that's probably not going to worry you too much because you can wait for property values to recover. But in this situation, they wanted to sell the property to pay off the big mortgage, and that's the real issue that we've got here. And it's important to point out that sometimes investing in property doesn't work out and doesn't work out quite as simply as you might think. And it is exactly the same with shares and all types of asset classes. because you might see property values increase, but then you also see them decrease as well. And the issue would have been if they bought new home, property number 3, the one that was going to be their forever home at the top of the market, they were thinking, that's great, my other property's increased in value too, we'll sell that to pay it off. But it didn't quite work out like that, the property value decrease. But just before we get to some of the things that they could do, I know you noticed a few other funny things that were maybe a little bit off.
Yeah, I mean, the interest rate aside, I think one of the other big things is how the debt is structured. So it's unusual to me, and I don't know if they've had the tax advice around this or the legal advice around this. Maybe they have, and maybe the advice was to have it exactly this way. But it's unusual to me to have a whole lot of debt on an owner-occupied property and no debt on an investment property because it's not very tax efficient and it's not going to protect your assets that well. So I would have thought that there might be a more tax efficient and more appropriate structure here where maybe one of those properties is moved to a look-through company. The debt then is stacked against the rental property. The rental income from that property helps service that debt, and there is no owner-occupied mortgage. And that would be a more common structure that I'd see in a situation like this, where someone has maybe a couple of rental properties and an owner-occupied property.
And again, that's not to say that they're foolish, but at least because there are a few things that aren't the usual money decisions that you might make or that an advisor might recommend, I think that might be what's contributing to their anxiety. And I kind of think, well, that's why you're writing in with these anxieties to the national newspaper rather than talking to your mortgage advisor or financial advisor about what you should do next. Because if you don't have somebody else giving that unemotional view on your situation, it can be quite easy to work yourself up. But the one thing that I'd just say is stuff is not going to be a good way of dealing with your financial issues because a journalist is not a financial advisor and their incentive is to write an emotional, attention-grabbing headline, not to give you advice about what you should actually do with your money, right? And if you look at a lot of the quote-unquote experts that they've interviewed, a lot of them are share and fund people who are basically using this as a way to say, that's why you don't invest in property, invest in funds and shares, preferably through our company instead.
I also think, I'm just thinking back about the mentality, and again, we're not criticizing these people. It's more just pointing out that actually they're probably in a much better position than they think they are right now. But I think to Ed's point about being too close to the wood to see the trees, if you are doing this yourself rather than getting a financial advisor to guide you through, a financial advisor's probably seen lots of different situations and knows how to redirect your situation when something doesn't pan out the way that you expected. But if you've done this yourself and it hasn't gone the way that you planned for yourself, it probably creates more of a catastrophic situation in your mind than is actually the reality.
Now, if we look at their situation and think about what they could actually do next, so let's say these are their real numbers, that we talked about before, $1 million original home, $1 million new home. That's probably not exactly the numbers, but if this was kind of their situation, what could they do if let's say their original home's gone down in value by $200K and they've got $800,000 of equity in that? What might they do in their situation? Recognizing we don't have all of the exact numbers.
One of the things that I think is, I really, if everything is in Wellington, whilst I think, that's not ideal had they had the benefit of hindsight, but they don't, we're here now, is figure out, well, how long can I actually make this work? So for example, if I'm getting rental income from property number 1, my original home, can I service the mortgage on my own house? And yes, it's not ideal. And yes, I'm locked into a 5-year interest rate. And yes, that might be higher than what today's interest rates are. But if I can make it work, because I don't need all my money all at once in retirement, well, maybe I get to retirement and I cash in my KiwiSaver and I use the super and I can live quite comfortably for 5 years. Well, that gives you 7.5 years. Do I think the Wellington market will recover in the next 7.5 years? Probably. Probably it would. So I'd probably then do some numbers on, okay, well, what would I need the market to be, or how much would I need it to increase? If it was flat for the next 3 years and then I started to get a little bit of growth, how long would it take to get the number that I need? And I'd probably model that out as number one.
You could also do some interesting things potentially around debt. So, for instance, if they sold property number one, their original home, they could probably pay off a massive chunk of their own home, but they might still keep some available as a revolving credit to help them get through over those first couple of years while they're potentially waiting for the market to recover.
Yeah, they might also redo the numbers. I mean, maybe property number two hasn't dropped as much. And yes, that was the one that they were originally planning on keeping, but maybe they just reverse which one they sell. Maybe they could put some money into renovating it and then getting a really good price on the market. Or maybe what they do is they sell the original home, property number one, they pay the real estate fees, they pay off the bulk of property number three, and then they restructure the debt so that the debt is against property number two, and they try and get their rental income up on property number two, the rental property that they're going to keep long term, so that actually once they pay the mortgage, they've still got enough money to live on.
And I don't look at this as an example of when property investment doesn't work. I kind of look at this as an example of when property investment does work.
It's done well.
Now, it might not be that they're going to be able to live the exact lifestyle they would have been able to live had they sold all of their properties at the top of the market. But, you never know that it's the top of the market until you get past that. But the truth of the matter is they've likely got at least $1.5 million worth of equity across these two mortgage-free properties. There's a hell of a lot of wealth in there, and the question is just how do they best use it? Now, they might not have quite as much wealth as they did at the peak of the market, but they've still got a lot there. But this does show us something that you really need to know if you're going to be investing in property, which is just simply that property values can go down, and that where that really is an issue is if they go down and you needed that money relatively quickly. And one thing I should just mention as well, this is obviously, if this couple watches this video or listens to this podcast, this isn't financial advice about what you should do. It's just saying these are some of the things that you should think through with a financial advisor. And if they were kind of sitting in front of us, Andrew, what would be the first step that they should take?
Well, I think the key thing there is exactly what you said. You actually need a financial advisor. Like, financial advisors are trained to be able to run the numbers and run different scenarios. And whilst great that Stuff have got the story out here because it puts the possibility. Sorry, and I think great that Stuff have written this article because it's useful for people to know the good and the bad of property investment. But again, I think this is a good news story rather than a bad news story, in all honesty. But a financial advisor is going to be able to model the numbers and probably just give you a bit of a sense check and talk you down off the cliff so you don't make a rash decision. Because I see people like this who think that they're in a bad position, but actually have quite a few options and a few levers they can pull. They make knee-jerk reactions because they're panicked. They sell, they crystallize all their losses, and then they don't think through, well, what other strategies are here so that I can weather the storm? Because I think these people probably can. They just need to know what it actually would take and what a better structure might look like.
And obviously, there's a lot of things that are not going to be written into that article, so we don't necessarily have in front of us. But another thing they could consider is, okay, we just need to really focus on the first 15 years of retirement. By the time we get to 80, if we've run out of money at that point and we've got a $1.5 million house with no mortgage in it, then we could always do a reverse mortgage on that for a little bit, and that's going to help us out. Now, of course, there are lots of things to think about, like do they want to pass money on to their kids? But there are options there. The other thing that's interesting is that the right decision may actually be to hold on, depending on what else they've got going on with KiwiSaver, rather than selling at the bottom of the market. Because we always say, the perfect investment that a lot of people think about is you buy low, you sell high. But in this case, it seems like they're considering the opposite, which is buying high and selling low. Now, that is a recipe for crystallizing your losses and losing money in real life, not just on paper. Now, if we look at Wellington City, it is currently undervalued by our models, which is to say that not that property prices are going to bounce back immediately, but over the medium to long term, I would expect them to recover from those lows, especially if the plan is to sell the property, pay down a mortgage, or they've locked in for a 5-year rate. If they sell it today, they might have to pay break fees, and that's not ideal either. But I think the three main takeaways is that property doesn't always work out. It's not a guaranteed success. The second thing, as we said, is get a financial advisor. And the third thing is just to take a beat and not make any knee-jerk decisions or reactions, because you don't want to be making those decisions where you are in a really emotional state. Now, one of the reasons people often don't get financial advisors, though, is they don't know who to talk to. And one option, if you are investing in property, is to work with our company, Opes Partners. So if anybody's interested in creating a free wealth plan with one of the team members who Andrew and I have trained, you can click down below. We'll put a link in the description. You can book in that free 60-minute call. By the end of it, you'll walk away with a written wealth plan.
So property investing doesn't always work perfectly, because even smart, careful investors can make costly mistakes, which is why you need to learn from property investors who have actually made money. So your next step is to watch this video where you're going to learn the untold stories of New Zealand property millionaires. Click here to watch it now.